in the marketplace at all times. I like sharing my analysis on YouTube and interacting with other investors to see if we can help each other just become better investors, get a better return on our portfolios, make more money for our families. It's something that I've been doing for a long time and really enjoy it. As you look at any of my videos in this live stream, keep in mind I'm an individual investor, just sharing my experience and my journey as an investor on YouTube. I'm not recommending you buy or sell any of the stocks that I'm going to talk about on this live stream. I'm not providing any financial advice. Please weigh your decisions carefully as you make decisions to invest in stocks, bonds, or any other type of investment. So to get started, I wanted to just kind of review what the stock market is looking like, maybe look at performance over the last month of the major indexes and see if I can pick up any trends. And also look at a couple other factors that weigh on stock prices and try to see, what I'm feeling with regard to valuations and give you my opinions there. Also share with you lists of stocks that I'm planning on continuing to buy and 2 stocks that I plan to sell this week. I'll share those with you. So to get started, looks like we got people coming in to the live stream. Thank you so much for joining. Please ask questions, comment anytime. I'll respond to those comments as quickly as I can. So looking at, I wanted to focus on the Russell 2000, which is the Russell 2000 is made up of smaller companies. These are small and mid-cap companies. And these are a lot of companies. I think as we do live streams and we look at companies, there's been a good number of these small mid-cap companies that we've analyzed. And a lot of them have very good valuations. Now, one of the things that I've shared as I've provided kind of like my review of those companies is that small mid-cap companies have not really performed all that great for the last, call it year and a half. And I'm a believer that you can't keep a particular part of the market down forever. And if it is kind of held back or left behind, maybe it might come back and really outperform the big major indexes like the S&P. So the Russell 2000 over the last month has done, it's actually down by 0.66%, where the S&P is up just slightly at 15. The Dow is made up of the older companies, dividend payers. These are like, companies that have been around for 50, 100 years. And that is up 0.3%. Overall, the market's fairly flat. The NASDAQ is down a little bit. So over the last month, the market had a 5% pullback in the month of April. Now we're seeing that this past week was actually a positive week. And I think we've had 2 positive weeks so far. So year to date, the Russell 2.33, S&P 10, the Dow's up 4.7, NASDAQ up 10.67. And this is what I comment on is, man, these small mid-cap stocks continue to lag. They fell behind and they continue to be behind. Again, I'm not purely a contrarian investor, but I'm a value investor. I'm looking for value. Every market, whether we're in an expensive market, which is where we're at, I believe right now, or we're in a very discounted market, totally sold off like 2022, each market offers up certain stocks that are discounted. And it might be that small mid-cap stocks are discounted this time because they haven't done all that great. Looking at the yearly, the Russell's up 18%, the S&P's up 26%. NASDAQ is up 33%. So tech stocks and, all the companies that are just crushing their revenue line, they're doing really well. Over a 5-year, again, Russell not doing that great. S&P's doing phenomenal. Dow is doing okay, and the NASDAQ's doing great. So I would still be cautious with small and mid cap stocks because, the data doesn't lie. The data is showing me that small mid cap stocks they're not as investable to investors. And I imagine the big hedge fund managers that are managing big amounts of money are probably careful when they invest in small cap stocks. And the reason for it is they obviously want to ride the S&P momentum, the big tech momentum, the semiconductor momentum, but they also don't want to be criticized by their investors and say, hey, why did you invest in this obscure small company I've never heard of? Oh, okay, well, I thought this small company was going to go places. So I think there's less of that tolerance to really take a chance on these smaller companies. That's a theory I have. Overall, I wanted to point that out as we get started. And I will carefully continue to invest in small, mid-sized companies. And I will continue to factor in the fact that small gets a higher discount, or I should say, will be priced at a lower price just because it's a small company. So keep that in mind. All right. So I see I've got a number of people, please ask questions. Would love to hear from you. And let me know if there's a stock you want me to look at, or if you have a question on anything that I'm covering. Okay. So one thing that I wanted to also all right. So just wanted to put a note out there. So interest rates have gone up. And if you look at the 1 year, they've gone up, but I want to show the 5 year. I think that'd be a better representation. 4 years ago, interest rates were really low, and interest rates is a factor in valuing a stock because that's the discount rate. The higher the discount rate, the less that company is going to be worth because we're demanding a higher return. And with interest rates going up 4.5 times where they were just 3 years ago, that's a huge increase, right? So that's one thing to always keep in mind is, okay, what's that doing to the markets? It's driving a lot of investment away from stocks to fixed income, bonds, CDs, money market accounts. And that's just a factor that is real now. 3 years ago, it wasn't, driving a lot of capital, or wasn't attracting a lot of capital, fixed income, because interest rates are so low. But the Federal Reserve has said, hey, we're going to keep interest rates higher for longer. So it's making fixed income investors more interested. And it's making equity investors, realistic about, hey, maybe if I'm sitting on an NVIDIA gain and I'm up on the stock big, maybe I can take a quarter of that and then put it in fixed income and earn a pretty good yield on that money for a year or 2 years till I see this market maybe sell off and get discounted a little better. So interest rates is something that I always factor into my overall awareness of the market. And I think that this continues to put pressure on stock prices, downward pressure. And as a side note, it also puts pressure on real estate. So as you have higher interest rates, we'll see what happens. Hey, Scott, how are you? So thanks for the comment. Do you think there will be a rate cut this year? Thought it was going to happen already. Yeah, let me comment on that. So, man, if we go back in the time machine 6 months, I think people would have sworn on a stack of Bibles that we were going to have 3 or 4 rate cuts in 2024. People were pretty sure of it. We were seeing inflation reports that were showing that inflation was going down. As of right now, my best guess is we're going to have 1 rate cut. And The reason I say that is that the unemployment rate is ticking up. Job reports are pointing that, although companies are growing, they're not growing all that great, and we're losing jobs. So as we head to the back end of 2024, I think the Federal Reserve will want to stimulate more growth, and they probably don't want to be late if you're losing jobs. That's politically a PR nightmare. If all of a sudden we go to an unemployment problem and the Fed kept interest rates really high, I think the Fed would just get grilled on Capitol Hill. So having said that, I'm expecting one, because the inflation data that's come in, inflation is still around. They were hoping that it continued to go downward, but it's actually creeped up. And the economy is doing okay. As we cut rates, I heard something interesting over the weekend. Cutting rates is not all good news. Now, the mathematics is positive, right? Okay, great. We're going to have a lower discount rate. So when I value, for example, Robinhood, I just did a valuation of Robinhood, so it's fresh on my mind. If I lower my discount rate, then it's going to make Robinhood stock price increase mathematically. Okay, I made that point, but let's step away from it. What do rate cuts signal from an economic perspective? High level, let's take a look at the overall economic situation. Rate cuts signal that we're headed toward a recession. Rate cuts signal that the Fed has to stimulate the economy because companies are going to begin to struggle. They're going to struggle and they're going to let people go. There's going to be unemployment. So that's going to drive fewer consumer demand because they don't have as much money. It's going to drive a lot of things down. So rate cuts are good news, but if all of a sudden the Federal Reserve said, hey, we're going to have to cut rates like 6 times in a row, educated minds would probably say, wow, the situation's really bad. And they're seeing some stuff in the near future that's going to be bad. So one rate cut, it's been kind of a limbo couple of years where we haven't really had a recession. We've had this inflation, and the Fed's been trying to battle that inflation. So that's my feeling on it. It's going to be, from an interest rate perspective, it's going to be kind of a consistent year, and we'll see what happens. And I don't know that one economic report's going to change the Federal Reserve's mind very quickly, because they've had a couple of economic reports that showed inflation rise, not terribly, but it rose. So if they have one report that says, oh, it's dropping, well, that may not be enough. They might need to see 2 or 3 consistent reports of inflation heading down. So thanks for the question. I appreciate it. Love to hear your comments on where you think interest rates are headed. All right, so we covered just a quick review of the markets. Now let's talk about, what I plan to do. And the two things, I headed into the weekend with a desire to just create more cash. I happen to, and I've not the first time you're hearing it, I happen to think the market is expensive. And I'm not here saying, hey, I can predict when the market's going to go up or down. Not saying that at all. But I just look at valuations and I'm like, man, it's really hard to find a really good deal out there on a company I love. Everything is trending up, and it has been trending up for about a year and a half. So at what point is the market going to have a relief in those gains and really pull back 10, 15%? I think that's going to happen in 24. I can't tell you if it's going to happen next week, next month, or in 6 months, but I think it's going to happen. So got a question here from Lars. Hey, Lars, thanks for tuning in, man. I think it's the first time that I get a comment from you. If you will dive into small single stocks. ASO, yeah, we can dive into ASO. Love to. Give me a few minutes. Let me finish my train of thought, and we're going to look at ASO. So I think the market's expensive. So I'd like to just, have more cash in my overall portfolio. So the 2 stocks that I found that I want to sell. The first one was easier than the second, and that's DoorDash. So DoorDash, I really believed in DoorDash about a year ago. I invested, not a ton of money, $6,897. I've made some money on it. I've made 26%. I'm happy. It just recently had a big drop. The investors didn't like their earnings. I think they saw something in there that it scared them. I don't think that the growth for DoorDash isn't going to be like a perfect, really steep angle of growth, which it never is. I mean, business is business. You grow, you hit a problem, you fix a problem, then you keep growing. And nobody should ever expect a smooth, perfect growth rate. But I love the company. I think they're really focused on, food delivery. I think they're doing the right things, but I also think that they're priced at a premium of 21%. So I'm going to sell DoorDash. And there's another reason is I own Uber. I own a pretty good sized position of Uber. And I can't see it on my spreadsheet really easily, but from memory, I've got somewhere around $60,000 or $80,000 of Uber. So I'm still in that type of business, which is, Uber does ride sharing, but they also do food delivery. And I believe that in owning Uber, I'm owning the leader. I mean, that space, Uber is the biggest name, has the strongest business. So I'm going to sell my stake in Dash. Still believe in the company. Second one was a little harder, US Bank. And at one point, I was up really nicely on US Bank. I invested in banks toward, I'm going to call it in the third quarter of 2023. And the reason for it is that if you recall in the springtime of 23, we had that big bank scare where you had Silicon Valley Bank go down because they had a lot of long-term bonds that they had to take a loss on, and that scared investors and they had to run on that bank. That created a big scare in banking. And all of a sudden, all these banks were discounted for 30% for no reason. Like US Bank was the same bank they were the week prior, but bam, they were hit with like this big price reduction on their stock price. So I thought that was overdone. So I started buying US Bank, Citibank. I also own Ally, which is a bank, digital bank, and Robinhood. And Robinhood has like a bank segment to their stock. And the stock, I mean, I was up 25, 30% at one point. Recently, it's been really selling off. And I'm not selling it because it's been selling off. I just want to reduce the number of companies I have in financial services. So I'm going to trim that back. And I've got stock worth $14,189. So just create, collectively, I'm going to have $23,000 more cash to work with. Now, I continue to think that there are some companies that are discounted, and I'll go with the buy big category, which is CVS. My friend Scott covered CVS yesterday, and I'm going to go into some analyst reports on CVS. I happen to think CVS is highly discounted. When I look at their financials, I see a lot of value. I see the company is growing. I see the company's generating free cash flow. I see a consistent business. They're not just a retailer. They also are a healthcare payer, like a United Healthcare. And not only are they that, they're really growing a part of their business, which is they're a healthcare services provider. And it kind of makes sense that they have all these locations, where their retail are located. Now they can provide, more health services. So if you need, they were already doing like flu shots and stuff like that. But if you actually wanted to go in and see a nurse practitioner or a doctor, that's offered in a CVS location. Very convenient. I think of my, obviously I've been a healthcare customer for my whole life. And, getting to doctor's appointments sometimes is the biggest pain in the neck. So if they make it easier for me, I'm happier. And CVS, I think, is innovating in a category where it's going to make them different. And they're going to be able to have more of the wallet share of the customer, the healthcare customer. And obviously their pharmacies that's the cash engine of the company. So I'm big on CVS. And when I say buy big, I'm buying, $500, $1,000, depending on how the stock's trading in a given week. I might even go $2,000 in a given week investing in that stock. Pfizer. So Pfizer, had been beaten down, left for dead, just in this stock, another stock where I look at their financials and go, I would think that investors are brighter, smarter, and can kind of see the big picture. I like comparing Pfizer 2023 versus Pfizer 2019. Eliminate the COVID years, because those years would just throw all numbers out of whack, especially for Pfizer. The company was a $41 billion company in 19. They're a $53 billion company in 2023. Obviously, growth. That's great. In between, in 2021, they doubled their revenue from the prior year. Doubled. They created upwards of high $38 billion of free cash in 21, another 35 in 22. Just a big, giant basket of cash went on their balance sheet. And those 2 years are very difficult compares. So when you compare those to 23, it looks like a disaster. Oh my God, you went from 100 billion in revenue to 53. You guys are just a bunch of idiots running a bad company. Well, that's not the whole story. The story is it was COVID. It was temporary, and they made a lot of money, loaded up their balance sheet, acquired a big business that is going to begin to produce revenues, profits, cash flows. So when I look at Pfizer, I look at a ton of value, and they pay me a 6% dividend. They had a very good earnings report. Investors really like what they saw. Stock rallied, and I'm going to keep buying. I wish I owned $100,000 of Pfizer at this moment, but I'm not there. And I'm going to buy probably $1,000 at a time of Pfizer. Starbucks, I own very little of it. I think it's highly discounted, and it's the number one player in their category. We can argue about whether, a latte is too expensive and so forth and so on. But the best, biggest brand in coffee is Starbucks. There's people that just cannot survive without going to Starbucks. I have a lovely wife. She's awesome. She has her Starbucks every single day. And that's great. When we vacation, we go to Starbucks. It's a known commodity. So Starbucks, Comcast. I've made money on Comcast. If you look at their charts, really discounted right now. Pay a nice dividend. I am happy. What's cool about value investing and looking at companies for a long time is you can kind of see where a company's discounted, you buy it, you make money, you're like, all right, cool. Now the price is a little too expensive. I think I'm going to lighten up on it or get out of it. That's exactly what I did on Comcast. I made good money on it. I got out of the stock like 4 or 6 months ago, made a nice return, realized the gain, was paid a dividend in the meantime. Now I'm back for more. Happy to do it all over again. Nike, number one in their category. Happy to buy Nike. It's discounted. My only problem is it came down. I started buying and then it went up. So it makes it hard to buy when a stock's going up really fast. But every time I have a good opportunity to buy shares, I'm buying like $1,000 at a time. I am nibbling. Well, actually, I'm buying bonds. So the one bond that I wanted to point out is I'm buying into Kroger, a bond that matures in 5 years. I have a bond ladder. You'll see a bond ladder video released in about 4 days. And you look at the yield on this bond, 7.7% on a corporate bond. I'm already a Kroger stockholder. I analyze the company. I think it's a good company. So I'm buying into bonds. I put, so far this month, I've put $4,000 into my individual bonds. And they pay a really nice interest rate. Think of it as a dividend. And that dividend is really showing up in my income, my overall income. And these are very low risk, which is, hey, at the end of this term, they're going to return my capital and they're going to pay me a nice interest rate in the meantime. All right. So the other stocks, I'm going to call them more like I'm buying, lower amounts. is MPW high risk, but I think they had a good earnings report, and I think they're going places. They pay a 12% dividend, and they are going to pay that dividend. ZIM has been flying up. This one, you saw the shares go, the short sellers go from 33% to 22% last week. The stock is up like 71% in the last, I'm going to call it 10 days. This stock just really took off, and this is a stock that Scott reviewed on his channel. And the story on, I mean, I could tell you 10 stories on ZIM, but it's a stock that I'm going to keep buying on down days. I think the stock, I'm going to sell my position, and I'm part of this Reddit subreddit. I think it's trading at 17. It's going up so fast that if it hits $30 a share, I'm going to sell all my stock, because I think then at that point, it's just kind of, right now it's beginning to get parabolic, but if it goes parabolic, I sell. That's what I tend to do, because if I can't explain something, I'd rather take the money and run. Robinhood, I just made the decision this morning. I was in holding my Robinhood stock. I just redid my numbers today, this morning, an hour ago, and I am buying Robinhood. These guys, in their category of financial services, they're number one. They're taking over the younger investor population. They just do it the way younger investors like it. They gamify kind of investing. I have a Robinhood account. I don't get it. I'm 55. I shouldn't get it. I'm too old. I was raised and grew up in a different era. So for me, I use a traditional platform, but I'm happy to make money on Robinhood. So I'm going to keep buying Robinhood. I updated my from hold to buy on Airbnb. I just think the world of this company. I have a big investment in Airbnb and will continue to invest. Alibaba, things are, we haven't heard any bad news on China for a while. I know TikTok's in the news, but that's a different animal. But as a whole, I think China has kind of been, no news is good news in that front. And, I've heard a couple of investors out there that I believe or trust, and I think Alibaba can go places. I think it's discounted. If you look at the numbers alone, you always get to a discount. And then ALLSTATE's been a winner, and I think their business is just going to keep getting better. So that's ALLSTATE. All right, so let's take a look at, I think we want to look at ASO. So Academy Sports and okay, so this is a retailer, and I own Big Five Sporting Goods. It's been a big loss. That's my number one loser. So let's take a look. So market cap of 4 billion, revenue is 6 billion. So you're paying less than the revenue amount of the company. PE ratio, forward P is 7.88. Looks good. Dividends a little low, 0.78%. Analysts are saying, hey, it's a buy and it's discounted by 34%. Okay. Over the last 5 years, stock prices moved in the right direction. This is a good looking chart for the last year. Boy, it was a great time to buy it back in October. It has been coming down in price. Okay. Looking at their financials, revenue went down in 22. It went up, substantially in 2021 because COVID. Everybody wanted to get some sports gear and go outside and do something because we were on lockdowns. We couldn't go to the movies or any other place where the social distancing rules were broken. So you got outside. So you went to this place, you bought a new baseball glove and started playing baseball outside or something. All right. In 22, revenue came down. 23 came down. Okay. That makes sense. Looking at cash flow, operating cash flow is 535 million, CapEx 200 million. So you got free cash flow in 23 of $330 million. Okay. So this company, I could tell you on paper, this company is going to show a discount. If you put that through a valuation model, if I put it through my valuation model, we're going to get a discount. And I'll do that. Since we don't have a lot of requests, I'll dive a little deeper on this one. So we went over cash flow, balance sheet. So cash is 347. What about debt? So total debt is 1.5 billion plus current debt 120. So let's call it 1.7 billion. Not too bad. Not too bad. Okay, so the forecast. So it's covered by 15 analysts. All right. And they're saying, hey, it's discounted by 34%. And earnings per share in 24 is $6.85 a share. And it's going to grow. Okay. 685. What's the stock price? 56. Wow, that's a good earnings per share compared to the stock price. All right, good. The dividend is safe. Payout ratio is 6.57. Okay, that's fine. Okay, so Academy Sports and Outdoors. Yeah, so this is a retailer. All right, so let's take a look at put that through my valuation. And I got a good company to compare to, which is Big Five. All right, so Big Five's been a pretty good loser for me. Retail has been really surprising on this category. And I would also say I've followed Macy's as well. I'm not the first one to say it. I won't be the last. Retail is a very difficult business. It's tough, especially the retail where theft is very rampant. It's hard. You have to hire employees. You have to lease out, retail space. A lot of headwinds. So, nonetheless, let's take a look at this one and see what the value is. So, all right. So, as a discount, okay, I think these guys are higher quality than Big Five, but I'm still going to use a high discount rate. Why? Because it's retail. I want a higher return. I'm not going to invest in a retailer expecting, hey, it's going to be just like Alphabet. Nope. I don't think the investing community is excited about retail. I think, if anything, they're afraid of it. So I think the cash flow from last year was, I think it was 530 or see, so 535. It's 230. Okay. So 230. All right. So cash flow last year was 230 million. Let's look at the quarterly. So they announced earnings on February for the period ending February 2nd. Retailers tend to have these fiscal years that don't end on December 31st because a lot of their peak is in the month of December. So it makes it really hard to close and show everybody, hey, this is what we did, plus returns. If everybody shows up on January 2nd and starts returning product, their revenue would be overstated in December. So they usually close a month later, which is what you're seeing here. All right, so operating cash flow 234, CapEx 55. Looks good. Looks good. Okay. So I'm fine with that number. If we look at growth rate, it's been pretty, it's hard to say consistent because you have this COVID year where they made a lot of money because everybody was just buying everything off inventory. You had supply chain issues and they were like, hey, like for me, weights, like I got my home gym going, I started it in 2019, but I really ramped it up during COVID because you couldn't go to the gym. Well, I couldn't find any product in the stores. I was just buying whatever they had. I went in to buy barbells and I left with like a new bench because that's the only thing they had. So that year there, they made a lot of money. All right. So it's hard to see a pattern here. So I'm going to have a very low growth. So when I grow free cash flows, I'm going to say, I'm going to play it safe and I'm going to grow my Here's long-term growth. I think long and short-term growth, I'm going to have at 4%. That's the same as Big Five. Okay, that's fine. Okay. So I'm going to grow up 4% for both the first 4 years as well as the terminal value beyond year 4. So the net present value of all those cash flows is $3.5 billion. Okay. Cash on the balance sheet, I think we had 347 million. I'm going to call it 348. Debt, we have long-term 1576 and 121. So we're at 2.2 billion as a valuation, but the market cap on this company is 4.18. Shares outstanding, 73 million shares. So let me double check my data entry here. So we were at 5. So this is 330. Excuse me. So you can call it fairly priced based on cash flows, but it's showing a 10% premium. Now let's look at our earnings per share calculation here. So all right, so earnings per share looked really good. It looked like they were going with, for 2024, $6.85. And man, the PE, they have a really low PE. If you have a growing business, it should be 12, but I'm going to go with 10. They're growing this really well, but I'm going to go with 4%. So it's at $56 is the value that I get per share. So on that one there, and I need to update this. So they're fairly priced based on earnings per share. So overall, there's like a 7% premium. It's retail, and hopefully, I'm just going to give you my comment, which is, I got to see a significant discount, significant upside to invest in retail. It's just too risky. And there's just nothing exciting about retail, right? You have Amazon constantly, competing against retail, and making it harder for these retailers to make money. You constantly see labor rates go up, so they have to pay their employees a higher rate. So overall, that's my opinion on Academy. I would not be an investor in Academy. I've lost a fair bit amount of money on Big Five. Big Five paid a really nice dividend. They were part of a short squeeze a couple of years ago that I participated in. So Big Five was. So that was fun. But I think I kept too much emotion in that investment, and I lost a lot of money on Big Five retail. So those are my comments on Academy. Hopefully you found that interesting. Yeah, thanks, Lars. And again, I go through my process, and this is my opinion, but I hope you find it interesting that another investor looks at it. I get a ton of value. Like Scott's on the live stream, and I've been watching his channel for 3-4 years. Yeah, 4 years now. And when I watch another investor, I may on principle disagree, but I'm always learning something. And it's fascinating to see how, especially people that value companies differently and they have a point of view, I'm always learning, and it makes me better. Hopefully you found what I just did interesting. So good question. And we had time to dive deep. So a stock that I wanted to kind of showcase a little bit was Robinhood. So I am yeah, Lars, thanks for tuning in, man. Appreciate the question. Everybody, if you have another stock or idea or topic that you want me to cover, please can you please share the spreadsheet you use? So I've been asked that a few times, and I'm gonna get that ready for prime time and kind of get it shouldn't take a lot of effort. And let me think about how I can distribute it because I'm not quite sure how to do that. So I'm going to note that because you're the third person that's asked in the past week. And one note on the spreadsheet is you're going to see 3 different templates. There's going to be a template that you use like 80% of the time because it's companies that look like what we just did with Academy or what we're going to do with Robinhood. But then you have 2 other types that I kind of use a different model. REITs. You don't want to use free cash flow, in my opinion, on REITs because you're going to get weird numbers. You're going to see debt numbers that are going to be like off the charts. Yeah, because they buy real estate. And guess what? You have to take big loans to buy real estate. But the balance sheet's okay because if let's say you own oceanfront, resort in Southern California and it's worth $50 billion or $50 million and you have a loan for $30 million, I'm feeling pretty comfortable. Like, hey, that's going to be fine. If they had to sell that, they could sell it. If they had to sell it quickly, they'd get 45 million for it. If they had to sell it slowly, they'd get 50 million for it. So I'm okay with that debt. So there's most companies fit this category, REITs, and then financials like banks. You can't use free cash flow. You have to use 2 other metrics. And I am, so I have an MBA. I have a master's in business. I did portfolio management through my education. I learned a lot. I learned a lot of mathematics. But the way I apply those templates, I could thank Scott's due diligence for the first model. I don't have a model exactly like his. I created mine with his example in mind. And I learned a lot from his channel, especially I finally understood what terminal value was all about through Scott. And then for financials, banks, Cameron Stewart, that's another YouTuber. The guy's a CFO, and the way he values banks, I thought he understands banks. It made sense to me. So I copied I shouldn't say copied. I took what he did, as a concept and rebuilt my model for banks. So when you see the model for banks, you're going to be like, whoa, what the hell is this? And it's because you have to use book value and you have to use like earnings in a different way. So take a look at that. I use that for like Citibank as an example. All right. So Robinhood. So Robinhood announced their earnings and it went well. They had the stock, rose, and then it's really been selling off. Over the past year, great return, 69.95%. I'm not sure that's right. I thought it was higher. So let's go to Google. So Google's saying 85. And then I love this platform because they don't have a bunch of ads, but it's funny how one platform will say one price and the other. So Robinhood's been doing great. Annual return, happy to be a stockholder. Obviously, the 5-year really tells a different story because they IPO'd. Everybody's excited about Robinhood. The IPO price was super high. And I would say most IPOs follow this pattern. People are excited about the company. Hey, they're going to change the world. And I would say a good number of them, I can't give you like, is it 60%, 80% of companies end up following kind of like this kind of chart? I don't know. I observed that many of the companies end up doing this. But over the last year, it's doing phenomenal. Over the last month, you see this big drop. It's down. I think I saw from the peak, it was down much more. So it's down about 10%. But when I study the, investor, the earnings report, and when you invest in a company, I encourage you, read the earnings understand what the business is doing, and as you understand it, you form your own conclusions. Because if you just, like for me, I feel like I'm probably going to lose a lot of money if I just read the headlines and kind of invest based on the headlines. No, I really have studied the Robinhood business, and I'm like, well, what are these guys about? And they're a very different financial services company. They're catering to really the new generation of investors, and a lot of investors just get Robinhood, and Robinhood gets them, the younger investors. And now when I read their financials, I really like what I see. I like 40% growth. Phenomenal. I like net income. Their free cash flow exceeded the free cash flow I expected by a huge amount. And really, their user base is increasing. They have subscribers in these like different like subscription models. Now, when you go to the legacy financial services companies, they don't have any subscriptions. This is a concept that they're like, no, we were founded 60 years ago, and we used to charge everybody per trade. Robinhood changed the game when they came in and said, zero cost trades, and then all the other brokerages had to follow, or they lose all their customers. Cash went up, so just a lot of positive stuff in their financials. So I really liked what they showed from a fundamentals perspective, and it made me a bigger believer in their business. Hey, it's working. These guys are finding products that their investors want to buy. A lot of like crypto, they're selling subscriptions because that customer is totally in tune with that type of economy. So this is the stuff that I love seeing. Like when Google came out, okay? Google came out and said, hey, there's 20 companies that are all fairly good and big, like Yahoo and America Online. Believe it or not, that was a big company at one time. And they provided search for free, okay? And Google comes out and says, hey, we're gonna focus on search. And people literally laughed at them and said, oh, yeah, good luck with that. How are you going to make money on something that everybody else gives away? And needless to say, the rest is history. They dominated search, so they got all everybody to use their search. Then they had AdWords, and then they took away ad dollars from everybody. People went from advertising on TV, newspapers, and all kinds of other media to spending money on AdWords, and they revolutionized their industry. And to me, there's similarities to what our friends at Robinhood are doing. They're not like saying, hey, we're going to take Merrill Lynch, take that model and do it better. No, they're like, you know what? We're going to take a baseball bat to the current models, to the current way of doing business, and just hit that model with a baseball bat and start over. We're going to do it in a way that makes sense to people that have been raised with a digital device in their hands, and it's working. So that's what I'm getting out of their earnings. So needless to say, I updated my analysis, and I had a hold on Hood because I'm like, hey, I love this company. It's pretty cool. I'm like, I like what they're doing. I'm a believer in their business. Their fundamentals led me to think that, they were a good buy some time ago. And then I updated my analysis and went really conservative. They've already generated more than $800 million in free cash flow in 2023. So I'm still going to go to 800. And based on these metrics, they value at 26 billion, but their market cap's 14 billion. So just on cash flow, they're really discounted. Their earnings per share is a little anemic because they they give stock to employees. That goes against their income statement. And overall, it's a 54% discount on Robinhood. So I am buying Robinhood. and I hadn't been buying Robinhood in 3 to 4 or 5 months. But with the recent dip in the stock, I'm ready to buy Robinhood. I hate this when Google doesn't update. So with this downturn here, and if it keeps going, especially if we have a nice sell-off, I'll be buying Robinhood. So that was one that I just, reanalyzed this morning, and was excited about it. So I wanted to share it. All right. Good live stream. Thanks for the questions, guys. Not a lot of questions today, but really good ones. Any other questions before I call it a day? And while I got a minute, so everybody, happy Mother's Day. If you're a mom, happy Mother's Day. Have a great day. If you're not, whether you're a mom or not, reach out to the mom in your life, your wife, your mom, your sister, your aunt, whoever. Wish them a happy Mother's Day. Today I'm recording a live stream early because right after this, I will be setting up the house because we have people coming over, and it should be a great day to have, I think, a total of 5 moms come over, as well as family. So everybody have a nice Mother's Day. So it looks like there's no more comments. Everybody, thanks so much for your support. Really appreciate everybody tuning in. I appreciate all the viewers of the videos. It's been going really well. I've been having a lot of fun, and please keep the comments coming. I read every single comment and try to adjust and improve based on the feedback. And I really appreciate it. Everybody have a nice Sunday. Take care.